where Gary Boyson is joining us then. He's from Rand Swiss. An absolute decimation, 11.05% on the all-share index. Gary, we can't keep you here too long. There's a lot of investors probably wanting answers.
No, of course. It's been an absolute decimation today, as you said. Stocks feeling an enormous amount of pain. I think a lot of people are very concerned just with the reaction from certainly the equity markets around 100 basis point cut from the Fed. Many people saying this really is the Fed's bazooka. They've announced 700 billion in buybacks as well. So pulling out the old 2008 toolkit and buying in the open market again, trying to inject liquidity into asset markets, and yet still we're down. Australia finished down, I think it was 9.7%. We're off over 11% at the moment, and the market and the selling just continues. So that rally that we saw on Friday night late on the back of Donald Trump's speech, obviously going to unwind when the US opens at 3:30 today.
Yeah, why though? I mean, one would have thought that the bazooka, as we call it, the 2008 sort of esque stimulus that Jerome Powell announced, having learned, of course, from 2008, one would have thought we'd perhaps react a little bit better to the scenario. One thought that because we've now cut interest rates by so much to zero, of course, South Africa waiting for their own this Thursday, that was the move that the market wanted, but doesn't seem that way.
Yeah, I think there's a big difference between what we're facing now and the global financial crisis. So, the global financial crisis essentially in itself was the crisis. It was the potential seizing up of the banks, potentially people arriving at the ATM and not being able to withdraw money. Whereas here we have a financial crisis, but really on the back of like a health crisis, and a far more severe health crisis that I think still has a lot of unknowns to it. We've seen obviously the widespread shutdowns in developed market economies. We've seen obviously the banning of travel for 30 days between Europe and the US, or at least Europeans moving to the US. We've seen countries like Denmark closing their borders. We've seen, I suppose, some optimistic signs that the virus seems to be abating, or at least slowing, in South Korea, which is a heavily affected region. But overall, unfortunately, Europe and China, two of our biggest trading partners, obviously being hit. That's certainly going to affect the local market. But internationally, I think there's real concerns that this is uncontainable, and that essentially, we can what they call flatten the curve. We can try and prevent the spread through washing hands and taking the precautions recommended by health professionals. But the fact is, this is going to spread deep into the economies. It's going to put healthcare systems on an enormous amount of strain, and it's going to put enormous pressure on businesses, especially all those businesses that cannot, that are not part of the gig economy, that can't just have people work from home, that have to have employees actually arriving at the workplace. And already, if you look out 6-7 months, you can see there's going to be an enormous pressure in among small and medium and even large businesses as earnings come under enormous amounts of pressure.
Yeah. So is it all just fully dependent on whether COVID-19 is abated and perhaps kept at bay as much as possible? Will the market begin to rise despite it, or will it always be because of it?
No, it's an interesting question. So if you have a look at it, financial markets and stock markets particularly are leading indicators of economic activity. You've got to separate the economic impact and the financial market impact. And absolutely, we can see the economic impact is becoming clear. And already, as you mentioned in the headline of the show, we're already seeing it in the numbers in China. We're seeing industrial output falling dramatically, retail sales falling as well. And those kind of more lagging indicators are going to move through the market in the months to come. But with stock markets, because they really are, I suppose, the prediction of what's going to happen in economies, you could potentially see them turn a lot sooner than actual fundamental underlying economic indicators. If you cast your mind back to 2008, I remember the time to buy was March 9th, 2009, and at that stage I think we had US unemployment above 15%. We had real concerns that the financial system was going to collapse, and at that point I don't think certainly reading news headlines that you would have ever expected that markets could recover. As we moved into a recovery phase, everyone was discussing the double dip versus the V-shaped recovery, but financial markets were already up off their lows. So it's very difficult to tell where a financial market is going to bottom. And as long as this virus burns itself out, and if you see it at least not becoming endemic and not becoming a persistent occurrence year after year, and it ends up to be a short to medium term blip in economics, you should see financial markets recovering strongly. That said, there's still an enormous amount of unknowns, and that really, I think, is the problem and what's got markets spooked.
Look, Gary, we could talk about it all day. Unfortunately, that is all the time we have, though, this afternoon. But thank you so much for it. Really appreciate it. Gary Boyson there from Rand Swiss, live at the Johannesburg Stock Exchange there, unpacking the detail there for us with regards to that market. Well,